Well, if you've seen my, webinars in the past, since January of 2022, I have been bear, and it's been a long time. Usually, for the average recession or average bear market does last about 14, 16 months. This is probably going to be longer, right? Probably going to be longer. So I remain in the bear camp. Always said, simple reason, just finance 101. When you have rapid rise in interest rates, probably one of the fastest rise in interest rates in the past 100 years, or one of the fastest rise. Ultimately, financial system is going to be in distress, and at some point, you will have issues in financial market and lack of liquidity. So 2 weeks ago, this was just a kind of a textbook opinion without a lot of evidence, right? Because and we've seen this rally kind of confirming that inflation is low, people are traveling, China is reopening, everybody's buying cars, they're buying Gucci bags, and and life is good, right? So, but 2 weeks ago, now we have concrete evidence, right? And it's hard to imagine that it stops at Credit Suisse and First Republic Group, and there are I don't know what they say, 400 banks in the United States. I don't know, globally probably thousands of banks. Just can imagine that Silver Valley Bank was the worst bank, right? I understand they had very different business nature of business. They didn't have a lot of retail depositors. Mostly it was Silicon Valley, startup community. I understand it's different, but what about corporate real estate, right? What's going to happen with all these real estate and all the private equity that invested in real estate if liquidity is going to continue to be tight? And now it's even tighter, right? Because before it was just raising interest rates. Now not only raising interest rates and keep them elevated, well, now banks have to pay a lot more money. Basically banks are not encouraged to lend, right? And that's kind of resembles 2008 issues, right? Different issues. We don't have mortgage-backed securities that worth nothing. I mean, underlying assets seems to still be healthy, but nonetheless banks gonna lend less, right? And that means that to refinance your loan, if you have 40-story building all over the United States, it's going to be hard for you to refinance that debt as it matures. So for that reason, I think we are trading in the bear market, and this bull, right? We had a pretty strong sell-off, right? I would say, I do like Elliott Wave, so strong A, big drop, right? Multi-months drop. Then we have multi-months rally, right? To retrace, probably, usually it's a half of the losses, right? So we retrace half of the losses, and now we are in the beginning of wave C, right? Wave C. It could be the same as A, right? It could be a little bit less, it could be a little bit more. That will depend on the events, right? But I think we are trading in wave C, right? And this was inflation, right? Hyperinflation, right? Inflation went up. This is inflation went down, right? The reason, and now we're trading in recession, right? Probability of recession going, either entering some kind of recession or, right? So now completely different theme and correlations, right? You can see that, when QQQ is down, right, Treasury is up. In wave A and wave B, it was the opposite, right? Treasury's interest rate, bond market is down, QQQ is down. They moved in the same direction. Now they don't, right? And the same thing is in gold, right? So when market is down, people sell small caps and banks, and they're buying, silver and gold. So that's the new theme. Any questions?